Energy. It really is the lifeblood of, well, everything we do. Our homes, factories, nothing works without it.
That's right. And if you really want to get a handle on global growth, especially somewhere as dynamic as India, you absolutely have to understand its energy infrastructure.
Exactly. So today we're doing a deep dive into precisely that, India's energy scene. And we're going to look at it through a really interesting lens, something called an Infrastructure Investment Trust, or InvIT, specifically IndiGrid Infrastructure Trust.
And we're pulling our insights directly from the source today, IndiGrid's latest investor presentation, Q4 FY25, and their earnings call.
So you're getting real numbers, real strategies straight from them.
Exactly. No fluff, just the core details.
Our mission here is pretty clear. We want to dig up some maybe surprising facts, help you understand how an InvIT like IndiGrid actually works day to day, and peek into the future of India's power sector.
Think of it as your shortcut. You get to be well-informed without wading through pages and pages of reports.
Right. So let's start unpacking this. What exactly is an InvIT like IndiGrid? What's its main job?
Okay, so at its heart, an InvIT is basically a way to pool money from lots of investors.
Right.
And that money gets invested directly into real operational infrastructure assets. Things like power lines, substations, solar farms, stuff that's already built and working.
Okay, so not building new stuff necessarily, but owning the working assets.
Primarily, yes. The key is that these assets are designed to generate predictable cash flows over, really long time horizons. It's about getting investment into tangible things that are already producing income.
And IndiGrid themselves, they've got a pretty ambitious vision, right? Something like being the most admired InvIT in Asia.
I do. And they outline how a focused business model, always looking for growth that adds value, predictable payouts to investors, and keeping their finances, their capital structure, optimal.
What really jumps out at me is that focus on stability. You mentioned the long-term contracts, low operating risk, stable cash flows. That sounds, well, pretty solid, doesn't it?
It absolutely is. And that stability, that predictability, is precisely why the InvIT structure is so appealing if you're looking for steady returns.
Yeah.
They have a strategy, actually a requirement, to distribute a minimum of 90% of their net cash flow. So that's the cash left after running the assets and paying debt interest.
90%.
Minimum. It goes directly back to the investors.
Mm-hmm.
So you get this very consistent, predictable payout, almost like a bond in some ways, but you also get the potential upside from the assets themselves growing in value or scope.
Okay, so we get the concept, the mission, but let's talk scale. Because reading through this, the size of IndiGrid's operations.
Yeah.
It's kind of staggering. This isn't just a few power lines, is it?
No, not at all. To put some numbers on it, IndiGrid manages about 296 billion rupees in assets under management.
AUM.
296 billion, okay?
That's the total value of everything they control. Yeah. And what does that look like on the ground? Well, think power lines stretching almost 9,100 circuit kilometers.
That's across 52 different transmission lines, 15 substations, massive capacity, around 22,550 MVA. It's a huge network.
And it's not just the traditional poles and wires, right? They're into renewables, too.
Correct. They've got a pretty significant chunk of solar power generation, about 1.1 gigawatt peak GWP.
1.1 gigawatts. That's substantial.
It is. And they're also moving into battery storage, BES projects, looking at around 900 megawatt hours of capacity there, which is increasingly critical for grid stability.
And geographically, are they concentrated somewhere or spread out?
Spread out. Assets in 20 states, 2 union territories, all told 87 distinct revenue-generating parts to the portfolio.
So this infrastructure is literally keeping the lights on, powering businesses all across India.
Pretty much, yeah.
But are these like short-term contracts? Could things change quickly for them? Or is this genuinely locked in?
That's a really important point, and it's one of their biggest strengths. We're talking incredibly long-term deals.
How long?
The average remaining life on their transmission contracts is around 26 years.
26 years.
And about 19 years for the solar assets. So this isn't just long-term, it's, multi-decade revenue visibility. That's fundamental to their stability and those predictable payouts we talked about.
Okay, got it. So that's the big picture. Assets, scale, long contracts. Let's zoom into the recent past. Q4 of fiscal year 25. What were the standout achievements? What really moved the needle?
Well, one of the really big ones was commissioning the Kilakari BESS project. KBPL, they call it. It's in Delhi.
BES, Battery Energy Storage System.
Exactly. And this one's a big deal because it's India's first regulated utility-scale standalone battery storage system.
First in India. Okay, why is that so significant?
Its main job is grid stability. It helps smooth out the fluctuations, especially as more renewables like solar and wind come online. It makes the grid more resilient and helps integrate those green energy sources. It's genuinely a step forward for India's whole energy system.
That sounds like a major milestone. Anything else commissioned in the quarter that added to the momentum?
Yeah, absolutely. They also finished up some augmentation projects, like upgrades in places called PTCL2 and Column. That brought the total to 6 projects commissioned recently, using different bidding routes, TBCB and RTM.
So, steady execution on projects.
Definitely shows they can deliver. And looking ahead slightly, they also won a big new transmission project, the Rattle-Kiru Power Transmission Project.
What's that one for?
It's crucial for getting power out from 2 large hydro projects, Rattle HEP and Kiru HEP. We're talking over 1,400 megawatts combined.
Wow.
And once that's up and running, it's expected to bring in nearly 2,000 million rupees, or 200 crores, in transmission charges every year. So another long-term revenue stream locked in for the future.
All right, operation sounds strong, new projects coming online. Let's connect this to the financials. How did all this translate into results that matter, for potential investors or just someone curious about the returns?
Okay, let's talk numbers. They saw good growth. Reported revenue and EBITDA grew over 11% compared to the same quarter last year.
And EBITDA, that's earnings before interest, taxes, depreciation, amortization, a core profit measure.
Exactly. Shows the underlying operational profitability. But what's really impressive is their collections.
How so?
For their transmission assets, they collected 115% of what was due in the quarter.
Wait, 115%. How does that work?
It means they collected current dues plus some overdue amounts from previous periods. It really speaks to their efficiency in getting paid. Solar collections were also strong at 89%.
Okay, so cash is coming in the door very reliably.
Extremely reliably. And that strong collection directly fuels their ability to distribute cash. Remember that huge asset base, 296 billion? Well, their debt level is around 59% of that.
Which sounds like a lot, but is it manageable?
Very manageable in this sector. It means they still have significant headroom, room to borrow more to fund future growth without being over-leveraged, like having a good credit line ready for expansion.
So strong performance, cash flowing in.
Mm-hmm.
What did that mean for the actual payout, the distribution per unit, the DPU, back to investors?
Right, the bottom line for investors. For Q4 FY25, the DPU was 4.0 per unit, and interestingly, that was about 9.3% higher than what they had guided for earlier.
Ahead of guidance. It's always good to see.
Definitely signals strong underlying performance. And looking forward, they've given guidance for the next fiscal year, FY25-26, setting the DPU target at 16.00 per unit.
Okay, and how does that compare?
That represents about a 6.7% growth over the previous year's guidance, so continued growth in payouts. And just for context, since they first listed, IndiGrid has paid out a total of roughly 101 per unit. That adds up to over 62 billion distributed back to unit holders.
That's a significant amount returned to investors over time.
It really is. And underpinning all this is a very solid financial foundation. They've got AAA ratings the highest possible from 3 major agencies: CRISIL, ICARA, India Ratings.
AAA, that's reassuring.
Very. Plus, about 90% of their debt is at fixed interest rates, so they're largely protected if market interest rates go up. Their average borrowing cost is around 7.67%.
Which seems pretty reasonable for infrastructure finance.
It is. And their core earnings, that EBITDA, cover their interest payments more than 2 times over. That's a healthy cushion. They've also got a good amount of cash on hand, nearly 26 billion, and secured funding from the IFC for a new battery project in Gujarat.
The numbers certainly paint a picture of stability and steady growth. Now, I saw a figure that really caught my eye, 143% total return since listing back in 2017.
That's correct. 143% total return. If you annualize that, it comes out to about 12% per year.
12% annualized. How does that stack up against other options?
Well, if you compare it to, say, 10-year, 30-year Indian government bonds or even various stock market indices over that same period, it highlights what they call superior risk-adjusted total returns, meaning you're getting equity-like returns or even better sometimes, but potentially with less volatility, more like the stability you'd expect from a bond. You get that consistency from the long contracts, but also growth potential because they own critical infrastructure in a rapidly growing economy. It's really a masterclass in delivering consistent performance.
It sounds impressive, but it does raise a question for me. You mentioned InvIT's focus on operational assets. And there are rules, right? Limits on how much they can invest in projects that are still under construction.
That's a very sharp point. Yes, there are regulatory limits.
So how does an InvIT like IndiGrid keep growing aggressively, bidding for these big new projects like Kiru, if they're capped on construction risk, how do they square that circle?
Right, that's the potential bottleneck. As an NVIT, IndiGrid is limited by law. They can only invest up to 10% of their total assets under management in projects that are still being built.
Okay, so with roughly 300 billion AUM, that's about 30 billion they can have in construction at any one time. Oh, wait, the source said 30,000 crores AUM, which is 300 billion, so 10% is 30 billion, or you owe 3,000 crores. Let me reread the source. AUM is 296 billion, roughly 30,000 crores, so 10% is 3,000 crores.
Exactly, around 3,000 crores, or 30 billion, which sounds like a lot, but for the scale of infrastructure projects needed in India, it could definitely limit how quickly they can grow by building new things themselves.
So how do they get around that? Because clearly they're growing.
This is where their strategy gets really interesting and, frankly, quite innovative. They've set up something called IndiGrid.
IndiGrid. Okay, what is that?
Think of IndiGrid as a separate company, a development platform. It's designed to have a much bigger appetite for taking on construction risk than the IndiGrid NVIT is allowed to have.
And who's backing IndiGrid? Is it just IndiGrid?
No, that's key. It's backed by other major investors, like Norfund, which is the Norwegian government's investment fund for developing countries, and British Investment International, BII, which is linked to the UK government.
So strong international partners.
Right. And because IndiGrid isn't bound by the NVIT's 10% rule, it can take on much larger projects from scratch, maybe a 10,000 crore project, for example. Things IndiGrid couldn't fund directly under the rules.
Okay, so IndiGrid builds it?
Yeah.
Then what?
Then, once the project is fully built, commissioned, and operational, generating stable cash flow, IndiGrid sells it to IndiGrid.
Ah, I see. So IndiGrid acquires the asset after the risky construction phase is over.
Precisely. IndiGrid gets to add stable, income-producing assets to its portfolio, growing its AUM and distributions, but without having to carry that early-stage development risk on its own balance sheet. It's a very clever way to fuel growth within the regulations.
And they even shuffled management around to support this, didn't they? IndiGrid's COO and CFO moved over to become CEO and CFO of IndiGrid.
That's right. And IndiGrid's chief investment officer took on an expanded CFO role within IndiGrid itself.
That really signals how central this IndiGrid strategy is to their growth plans, doesn't it? A dedicated team focused purely on development.
It absolutely does. It shows a clear focus on both operational efficiency within IndiGrid and aggressive but structured growth via IndiGrid.
Is there any risk that IndiGrid might develop projects and sell them elsewhere? Or is it locked into IndiGrid?
That's a fair question. The way it's structured, projects developed by IndiGrid are intended exclusively for IndiGrid. The partnership is set up to ensure fair value for both sides, too. The pricing and terms are generally agreed upon right when IndiGrid bids for the project.
So transparency is built in.
Yes. It aims for alignment and avoids conflicts while maximizing that growth pipeline for IndiGrid.
Okay, that IndiGrid strategy makes a lot of sense. Let's pull back again now, look at the bigger picture, the whole Indian energy sector. What's the landscape IndiGrid is operating in?
Well, the headline is growth, massive growth. India's energy demand is just surging. We saw peak power demand jump 6.5% year-on-year just in the last quarter.
6.5% growth in demand.
And the projections are even more stark. Peak demand is expected to hit 335 gigawatts by FY30. That's up from around 250 gigaW today.
Wow, that's a huge leap in just 5 or 6 years.
It is. And to meet that, India needs something like 777 gigawatts of total installed capacity, including a significant amount of energy storage, around 42 GW is the estimate.
And renewables are a big part of that capacity growth.
A huge part. Renewables already made up 46% of installed capacity as of March 25, and that share is only set to grow substantially.
So the government's own plans must anticipate massive investment needed, right?
Absolutely. The National Electricity Plan for Transmission alone outlines a need for 9.15 lakh crore rupees in investment by 2032.
9.15 lakh crore. That's over $1 trillion equivalent, roughly. An incredible number.
It's a staggering amount of investment required, and it's being driven by everything from more electric vehicles on the roads to the explosion in data centers to just basic electrification reaching more corners of the country.
So lots of projects need building.
Which creates a very active bidding environment. Right now, there are transmission and battery storage projects worth over 53,000 crore rupees actively being bid on. It's a very busy space.
Okay, so bringing it back home to IndiGrid. With this huge market opportunity, how are they positioning themselves? What's the strategy going forward?
It's multi-pronged, really. First, maintain rock-solid operations on their existing assets, keep the cash flowing reliably.
Makes sense.
Second, keep pursuing those value-adding acquisitions. They have a pipeline of about 4,000 crore worth of projects already under construction that they expect to acquire by June 2027.
Okay, near-term growth already locked in.
Right. And third, strategically use IndiGrid to capture those big new greenfield opportunities that the market growth is creating. Let IndiGrid handle the development, then IndiGrid acquires the stable asset.
So a clear plan for both organic and inorganic growth, leveraging that unique structure.
Exactly. And underpinning all of that is a deep commitment to operational excellence. They target over 99.5% availability for their assets, which is incredibly high.
Keeping things running smoothly.
And they're investing in technology to do it better. They're strengthening their own O&M, operations and maintenance capabilities. For instance, they plan to roll out AI-powered image analysis next fiscal year to monitor their assets more effectively.
Using AI for monitoring power lines, that's pretty cutting edge.
It is. And finally, of course, maintaining world-class standards for environment, health and safety, and overall ESG practices. That's foundational for their license to operate and their long-term sustainability in shaping India's energy future.
Right. That brings us pretty much full circle. We've taken a close look at IndiGrid today, seen their solid performance financially and operationally.
Explored that really clever IndiGrid strategy they're using to drive growth beyond typical NVIT limits.
And we've seen how they fit into this picture of India's absolutely booming energy demand. They seem really well positioned, don't they?
They certainly appear to be, based on their strategy and the market dynamics.
So we hope this deep dive has given you, our listener, a clearer, more digestible understanding of what can be a pretty complex sector, and also insight into this unique NVIT financial model.
Yeah, the goal was really to cut through the noise and give you the key takeaways, the core insights, without you needing to become an overnight expert.
And just to leave you with a final thought to chew on, think about that strategic move, shifting key leaders into IndiGrid, that development arm. How does that redefine what an NVIT can achieve?
It's more than just growing assets, isn't it?
Exactly. It potentially allows an entity designed for stability to also play a really active role in building out and shaping the future energy backbone of an entire nation. It's a fascinating intersection of finance, infrastructure, and national development.